Welcome, everybody, to the Thursday edition of the Not Your Average Investor Show. It's getting hot in here, guys.
Woo!
A little
How about this?
light blue jacket weather. If you
We need
don't
to
ask
cool
me.
us down a little bit, make sure we color coordinate
definitely
here.
did not do this on purpose, to be perfectly honest. Not sure if you even noticed it was happening when you came in the room.
I'm colorblind.
You were so distracted by my mustache. Lack of mustache.
Where did it go?
I made a couple shaving errors. One on Monday, the other on Tuesday. By Wednesday, it had to go.
I don't know. I hope our audience stays because you are sans mustache. And I know how much we love it, but it's not here anymore.
I'm so much more than a mustache, guys. I promise. Today, we are talking about what does it take to actually get a rental income property in this market at this price point? How does it perform with different levels of down payment? Because it's one of the questions we get asked the most.
All the time.
All the time. So this is a new Portfolio of the Week.
Week.
You got your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because of his genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
It is great to be with you, buddy.
It is.
Yeah.
It's great to be with you.
Did I tell you to say hello?
You
Because you said hello.
I think you did.
Yeah.
Did I follow directions?
I think. Speaking of hello,
Yeah.
I can't wait to say hello to all of you coming for the Not Your Average Investor Summit on February 16th and 17th. As you all know, since you've been here for a while, phenomenal success in selling it out. Not so great success in planning. We should have planned it for 200 people.
I know.
Because now we got a huge waiting list.
I know.
And now the more people we get on the waiting list, the more I can peer pressure Greg into having a second event at some point this year. So make sure that you still go to JWBSummit.com. Summit has 2 M's and 1 T. I've made that mistake before. Sign up for the waiting list if you are really interested in attending this event. If you are already signed up, hopefully you've already joined the WhatsApp community chat that we got going on. We got little exciting announcements we're going to be making in there. I'm really looking forward to seeing the 120 folks that basically bought it immediately because or else it would have been sold out if they got to it.
Yeah, absolutely. And there's, for everybody who's wondering information on where to stay, we've updated that information. So go to JWBSummit.com. There's information there on hotel stays. We'll continue to share more and more information. The details are being put together and it's going to be a phenomenal event. And again, if you want to be a part of the event, there still potentially is an opportunity to accommodate more folks. We are mapping out all of the facilities here to make sure we can fill our with everybody who can be a part of it. So there is a real value to go and add yourself to the waiting list. I would encourage you to do that. And then hopefully we can host you here on February 16th and 17th.
Love it. Love it. My parents are coming. Your parents are coming. It's going to be a family affair, and it's going to be a family affair with our friends in the chat and those of you that join us every week and get to hear your names on what you see.
The roll call, baby.
Oh, leading us up today, we got the ringmaster.
Drew Barnhill.
All right. We got the Maven in the house.
Leslie Wilson.
We got the early bird checking in third.
Mr. Dean Curry.
We got our usual lead hitter going fourth today.
Lead off hitter.
Cleanup. Lead off hitter.
Lead off hitter batting fourth is normally how you say it.
Cleanup.
Yes, very good. John Henning.
John Henning. Much ado about that one. We got the patron Santorio stuff that Not Your Average Investor.
Michael Santorio.
We got our regulars. Rosalind and Gary Riley from Marietta, California.
We regard you.
We got the Mountain.
Billy Green.
Good morning from the vituperatively frosty mountains of Colorado. Man, yeah, you must have a thesaurus there, Billy.
That's pretty good.
Or the world's greatest vocabulary, because it's getting harder and harder. We got our amigo. Buenas tardes, damas y caballeros.
Mr. Bill Shields.
Mr. Bill Shields, good to have you. We got the Shaw man in the house.
Nadeem Shah.
We got Vincent Barbarat from Long Island.
Vincent is sniffing a nickname here soon, right?
Strong Island in the house. It's good to have you back, buddy. We got our buddy Leo Faraganan. Faraganan. Good morning from the Bay Area. Let's rock, Leo. Good to have you. We got the Mama Bears in the house.
Cody Adams.
We got Big Papa. I love it when he calls him Big Papa.
Pops, how are you, man?
the co-founder of the co-founder, Jay Cohen. We got the mystery man in the house.
Danny Davies.
Danny Davis, #1 attendee. Steven Chmielewski is back from Providence, Rhode Island. Still not ever really. I hope to meet you at the summit, Steven, so you can really phonetically pronounce that thing for me. Take away my.
I think you're on. I think you're there.
I think so.
Well, let us know. Let us know how we're doing.
I'm very nervous. It's a lot of syllables. A lot of consonants in a row. All right. Pamela Myers is in the house from Seattle. Good to have you.
All right, Pamela.
She's sniffing a nickname herself.
There we go.
What's we got here? All right, cool. I see everybody saying hi to each other. So if you didn't make it in the first round, okay, we got Stanley Jocelyn in the house. She's making Stanley's making a a regular
Making an
appearance here.
impression. That's what we call it.
Making an impression. And of course, we got the first family of the Natural Average Invest Show. Patriarch, matriarch, maybe the Duchess is in the house with him. Ken and Carolyn Moline.
We salute you.
Melvin Douglas in the house. That's a new name.
All right, Melvin. Melvin's a longtime client.
Yeah, good to have you, Melvin.
Great to see you, Melvin.
Yeah, buddy. Jeff Pettijohn, not a new name.
Not a new
becoming a
name.
regular as well. From Missouri. We got Luis Olivares, my buddy from Miami, 305 Stand
Right.
Up. Danette Colvin from Baltimore, Maryland.
There we go,
Good to
Danette.
have you here. And our favorite name to pronounce, Aaron O'Neill.
Into the lights.
And Sergio Prieto, of course. Go Gators.
Go Gators.
Good to have you in the house. All right, GC, let's jump in, man.
Game on.
Good roll call. I feel like that was 3. We're already at 73 folks. I told you it was going to be highly attended.
You did.
Because people want to know what are the dollars and cents here? What does it actually take to get you into a rental property?
What can I take
What?
to get you into a rental property
what's
today?
So as we kick off here, we got breaking news, GC. What's the breaking news?
Yeah, man. This is a stat that I love to share because it communicates so much more than the dollars saved here and the return on investment. I think it communicates how my team thinks and how my team wants to drive value. We keep track of every work order that comes into our office for managing the homes that we manage. How many of those work orders do we get to solve over the phone? Because what happens when we solve it over the phone, Pablo?
It is a better client experience. Their problem gets resolved immediately. They feel empowered to help themselves.
100%.
And it's less cashish out of the pocket of the investor.
Love that.
Yeah.
Love all those things. All of those wins happen.
Yeah.
So my team loves to do this. In Q4, 2023, so last quarter, we had 659 work orders that were solved over the phone. That's 30% of all requests submitted. And that's 659 work orders that we did not have to incur a trip charge for you as the client. And number one in this regard here is making sure that resident experience is top notch, because when the resident experience is top notch, your homes are going to stay rented longer, your return on investment goes up. So that's 659 work orders that was solved over the phone. That saved our owners over $65,000 in cost by saving money on those trip fees and other things that we were able to do. So huge shout out to our maintenance team who is passionate about this and passionate about the resident experience and about your experience as an owner.
I find it so impressive, right? Like as somebody who, as you know, I'm moving into a new home as a new homeowner, like the ability to like call somebody, like Martha was literally just like, who's our property manager?
Right.
Who do I call when something happens? Like I'm a little worried about it, right? But the ability to do this, I'm just going to reiterate the numbers. This is in Q4, right? So this is October, November, December, Thanksgiving, the holidays, right? Big time, big time. This is like
good call.
The time that is most important to like have your home working right. 659 work orders over the phone. That's what, like 215 a month?
Yeah.
Around there, some 220 a month.
Yeah.
30.41% of all requests and $65,122 for investors as cost savings that we didn't have to pay a handyman, somebody to go out there because they had a number to call and it was better for them to fix it themselves versus wait 48 hours and charge me $500.
100%.
$20,000, $21,000 a month kind of thing if you average it out.
100%.
Over the most important quarter of the year for us.
And you want to be with a property management team that cares about the little dollars, because the little dollars add up when you're a rental property owner.
Yeah.
And so you've got a team here that cares about the little dollars and the big dollars. And that's how we can, bring a wonderful client experience and resident experience to everybody.
Super impressive. Super impressive.
Yeah.
Speaking of
Can
people,
we talk about some other breaking news, by the way, man? What happened earlier today, buddy?
I closed on my new duplex where I'm going to live in one and rent the other out.
Hell yeah, man.
So closer to you, buddy.
Yeah, I noticed.
Yeah. Super excited.
I mean, I was talking with my wife today about your progression here as an investor and somebody who, I know you don't call yourself a real estate investor. Now you do a little bit.
Now that I got a portfolio of properties.
Can you take people back 5 years ago? Could you have envisioned that you would own 5 properties, 5 doors?
I did not, man. First of all, no, right? First of all, 5 years ago when me and you first started running in the mornings, 4 years ago, I remember just thinking, gosh, I know that I want to invest in real estate. I don't have enough to afford like the home that I want to live in forever, but I do have some money saved up, and I can either like buy a home somewhere that I don't necessarily really want to live and like just kind of like grin and bear it, or does it make sense for me to invest in these like cash flowing rental properties that pay for themselves, like month one kind of thing. And you talked me through it for like, it was probably like about 4 months of like talking about it. Should I do it with my 401k? Should I do blah, 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 right? Ended up going for it. And, fast forward to today where I made a couple of different moves to get my first three, but that put me in such a better position to not have, depleted what I had before to now invest into the home that I want to be in, not depleting my credit, right? Because my debt to income ratio has stayed where it needs to be. And now that I'm like, we're at this place where fortunately we've done well enough to save up a little more, qualify for some more, took advantage of like a change in regulation to buy where we want to be because we have a second property that's kind of like helping us pay for the overall
100%.
That's paying for the overall mortgage, and thinking that I have 5 properties, right? Like that I have a portfolio of 5 homes in a city that is, on the verge of becoming a great American city makes me feel phenomenal. Like
it's incredible, and it's not average. It's not normal. I mean, many people have the desire that you had, but either don't have the support network, they don't have the experience, or they don't have the courage to do it. And you had all those things. And that's why you're sitting here today as an owner of 5 properties, man. I'm really happy for you.
Listen, the support network is real, right? Like I think that was the whole point of this community thing. Right? Because you can watch YouTube and listen to like Orion Pineda telling you what to do. But if you're not like spending time with people that are normalizing the behaviors that you intuitively know are going to be good for you, but you just don't know enough people around you to take that leap of faith, right? Like cognitive bias is a real thing. Being here for the first year and having Jen and Lee and everybody else telling me I got to read Rich Dad, and Marilyn telling me I got to read Rich Dad, Poor Dad, and I got to do this. And then seeing everybody like buying and taking action, and watching my friend Rich be a guest on the show, saying the deal was the dead at the time, and recognizing that there are moments in time where if you make the right move, in 30 years, you're going to look like a genius, but that day you're terrified.
Yes.
Right? Like,
very true.
And just recognizing that, right? Like, so again, I think I took advantage of it then because of where it was at. I took advantage of the change in regulation to get a 5%, a conventional mortgage on a small multifamily if you're going to live in one.
Absolutely.
And I'm also feel like I'm taking advantage of this like information advantage that we have here, thanks to you and the data flywheel at JWB and what you guys are doing downtown, of knowing that I'm investing in a stock that's about to blow up. And what I mean is the stock of this city. And to be perfectly honest, man, I can say it 1,000 times. I had a really deep conversation with Martha, my wife, yesterday, when she was just like, man, I had a really emotional talk with my dad because, she thinks of where she was 3 generations ago. Her family, was a very, they're a very simple family in the mountains of Venezuela, right? Like her mom's grandparents are, you could say, South American poor, which is a very different version of American poor, right?
Right.
And all the things that have to happen for her to, her parents to take a step forward to like support her through her life, her to take a step forward and like look beyond the boundaries of her country, and then come here, take a step, have a leap of faith in our relationship and the things that we're doing in her career. And then now sit here and be like, we own 5 properties in the United States of America. Like her dad was blown away by it, man. And I'm getting kind of choked up talking about it, but it's a real thing, man. It's really incredible to break generational kind of like beliefs in what you're doing and setting yourself up for success long term.
That is an incredible story. I am really appreciative that you shared that. I didn't know that prior to us talking about it here. And I know everybody listening really appreciates that, because what you start to find is that there's a why behind why we are investing that is so much more than the dollars and cents, and so much more than the properties that we get to bring into our portfolio. And I often think that I'm standing on the shoulders of giants. I think about the generations before me that allowed me to be able to think like an entrepreneur and to do these things. And I know, it's a similar situation with you, with Marta, and it's incredible to be able to continue to elevate your family and reach these heights. So, and I know all of you can relate to this as well. So that's why we do this. It's a lot more than just
it is
rental properties and property management,
Yeah. And like the outpour of love right now happening in the chat, guys, like it means the world to me. Like, thank you so much. Like I really mean it. If you hadn't normalized it for me, I would not be thinking it this way.
Mm-hmm.
So thank you, to everybody that's been here for the last 4 years and been a part of this and pumped to like cheer each other on and the amount of love that's pouring out. Speaking of love, the fairy godmother's in the house.
Love that. Hello, fairy godmother.
Jen Filson, good to have you in here. And another little bit of breaking news. GC shared something to me that I was like, I'm definitely talking about this on the show.
Oh.
When I first was like talking to Gregg about like, oh, we're going to start this project. How big of a company are you? And he's like, $150 million company. And I didn't know what that meant. like I was like, oh, I guess those just fall out of the sky all the time. I now realize how difficult it is to grow a $1 million company, a $10 million company, a $50 million company, a $100+ million company. But throughout this time, as I've seen all this growth at JWB, I've been like, hey man, I still tell people you guys are a $150 million company. What's up with that, dude? And he told me that you guys crossed the $200 million revenue threshold, which I think is a extraordinary accomplishment as a company, as an entrepreneur starting this 17 years ago. Like, to think that you can get to this level is very foreign, somebody starting as well. So man, congrats. That's incredible.
Thank you, man. I think, what that means to me is that we have a bigger platform to impact lives positively. Yeah. And that's the way my business partners and I think about it. And that's the way that my team thinks about it. And when you have a platform like we have now, you have both a responsibility and an opportunity to really make an impact and to change people's lives. And so that's the thing I'm most excited about.
I love it, dude. Proud of you, man. So
thanks, buddy.
Amazing team you've built.
Thank you, buddy.
So, all right. So now that love fest, I could continue that all day.
How
buddy.
about that?
I forgot why we're
here.
No,
we were going to do any of that.
What's happening? Okay. So let's talk about the reason why everybody's asking why, like how much does it take to get in, right? Mm-hmm. In recent past, we have had extraordinary growth of property values in Jacksonville, aka prices have gone up. People that have bought in the last 2-3 years are phenomenally happy with how much it's appreciated.
Absolutely.
There has also been a rise in interest rates over the last year, historically faster than ever kind of thing. So, and what that happens when both of those forces combine is what you are, like the dynamics of cash flow and IRR and all these different things and price point, right? Like that's all one big recipe. So we want to kind of like take the ingredients apart and show you what the recipe is cooking these days. And if you are thinking about rental properties, how to think about it based on what the ingredients make today. Would you say that's accurate?
Yeah, I think, things have changed very much in the overall market and what it takes to get into investing in rental properties today. And it's much more than just prices going up. There are so many variables. And what my team is able to do with a new investor coming in or with a current client who is looking to add to their portfolio is to take all these variables and put together the right plan for you. So this call today is more about showing you the different variables. And I think you'll be able to take into account, where do you fit based on the pros and cons of each of these variables. And then hopefully it's a precursor for you to talk to the team, because once you have a sort of an understanding of how this works, matching that with a team of experts who have done this exact activity and manage over $1.3 billion in assets just like this, base plans on assets just like this, you can match that together, you can talk with the team, and then we can be off and running. And you might be just like Pablo, 3 years later, 4 years later, with 5 assets in your portfolio.
I never thought that would be something somebody says based on.
Hey, well, there you
that's
go.
Cool. That's really cool. All right. That being said, Jen fills in the chat. She's hosting a Northern California meetup if you're out there on January 28th. Details are in the chat. I can read it all out, but it's kind of a lot. But if you're here, you're live, check it out in the chat. She's put her number in and her details. It's going to be in Monterey. So if you're around January 28th, you want to meet some members of our community ahead of the February 16th meetup, check that out. And let's get started, shall we, GC?
Game on.
All right. So as usual, we got to start with a little something you want to
Yes.
share with everybody.
Anytime that I'm getting more granular and showing you estimates of return on investment and cash flows and down payments and things like that, I want you all to do your own due diligence and recognize that this is me coming up with highly educated estimates, but everything may be different for you. So do your own due diligence. Take responsibility for yourself before you actually make a decision to invest. Continue to be here to get educated, but don't just stop there. Do your own due diligence.
Okay, so let's get going. How much down payment do I need to invest right now?
There you go.
Let's start with 25%, GC. Talk us through it.
So when we're thinking about the right plan for a client, we're thinking about, okay, what are the ultimate goals in mind? Mm-hmm. And many times, once we understand the why behind the investment, which is always something more than dollars and cents, right? There might be a family legacy component to it. Mm-hmm. It might be sending your kids to college. It might be more of an income so that you can choose the job you want rather than the job you have to take. We understand that and we love that part of the conversation. Then we break it down into different components. Notably, we'll look at the profit centers. And so we start to build a plan that we understand how do we get to that why and what functionally has to happen. Like, for example, is there a certain cash flow requirement? Is a net rental income requirement? It's the same thing. Are we looking for maximum growth here? Can we give up some cash flow in order to get more growth, a bigger piece of the pie, 10 years down the line? And so through those conversations, which I would encourage anybody to reach out to my team. We haven't said how, but you can go to chatwithjwb.com at any point and set up a time to speak with my team. Or you can just simply send an email to info@JWB Companies. That's what you're going to experience over the course of a couple of conversations. It's going to be that type of discussion. So Pablo and I thought today the best thing to do would be to list out a few different scenarios. So one of the scenarios would be 25% down payment, mm-hmm. right? Technically, you can put as little as 20% down when you are buying an investment property like the ones that JWB sells. But we chose 25% right now because we wanted to choose 4 scenarios and I couldn't fit 5 on the slide.
Yeah. I remember that conversation.
There you go.
Yeah.
So 25% down is where we start, and we can kind of go through the line items if you'd like.
Yeah, I'll go through it. So okay. you put here $240,000 of a purchase price. That's about like an average cost of what is in inventory right now.
Absolutely.
We can expect somewhere between some range of that.
Yeah, somewhere around $180,000 to $280,000 as a purchase price mm-hmm. is very typical for inventory right now in Jacksonville. And to put that in perspective, we're in workforce housing neighborhoods. The overall median home sales price in Jacksonville is around $350,000 right now. So you think we're somewhere around 240-ish mm-hmm. on average. We're a step below middle income, which is where you want to be for the best risk-adjusted returns in rental property investing.
Got it. So that means that you got to come up with about $68,600 if you want to put 25% down. That means that your net rental income in year 1 is $1,247 in the negative, right? Mm-hmm. So you are out of pocket $1,247 year 1, but as we know, cash flow increases over time. Mm-hmm. So by year 10, you're in the positive $577 for the year. Mm-hmm. Your home price appreciation, which as we know is always the biggest profit center, will be around $96,597, and your total profits year 1 to year 10 is $116,226 with a total IRR year 10. If you were to sell the property, everything included of the cost of selling the property, you'd be making 9.9% on it.
Absolutely. You put 70 grand in over the course of 10 years, you make an additional $116,000. And based on the size and the timing of those inflows of cash, your total return on investment, your internal rate of return mm-hmm. is just about 10%. That's how much 10% earning year over year over year can do for you. It can take you from 70,000 to adding 116,000 on that. And that's why you can really start to change your life if you make a decision like that and stack that like 5 decisions like that over a 10-year span.
Got it. So what I want to do is go through the 4 different scenarios you see, and then we'll talk about the trends and the nuances between the different scenarios, right?
Perfect.
So let's say somebody has a little bit more to put down, right? They're putting 30% down using the same purchase price, $240,000. The down payment is now $80,600. So that's the cash you need to get in at that down payment number. Your net rental income year one is negative $407 at the end of the year. That's $407 out of your pocket by the end of the year. Net rental income year 10, because we know cash flow goes up over time, is $1,418. Your home price appreciation, the same, still the biggest piece of the pie, $96,597. And your total profits year 1 through 10 is $123,226. So you're adding $123,226 to your net worth in year 10. If you were to sell this thing, money in the bank, total IRR of 9.6%.
Absolutely.
Okay, cool. So now let's look at 35% down, same purchase price, $247,000. Your down payment's a little higher again, $12,000 more needed in liquidity to start, $92,600. Your net rental income is now positive year one, $433 at the end of the year. When you add it all up, your net rental income year 10, because we know cash flow goes up over time, $2,258. Home price appreciation stays the same, still the biggest piece of the pie. Total profits, the net worth has increased after year 10 in 10 years with $133,281. Total IRR, 9.3%. Now let's look at somebody that has even more liquidity to put down and wants to buy one property. Same purchase price, $104,000 down. Net rental income year one is $1,200, $1,274. Net rental income year 10, you're looking at $3,000. Home price appreciation, still the biggest piece of the pie by far, still $96,000, $597. And at the end of the day, your net worth goes up in 10 years, cashed out $137,000, $335, and total IRR of 9.1%. GC, what trends do we want to talk about here to start?
Well, let's put a question out to the audience, and I'll ask you the same question. Which is best?
Oh,
which is best? Which is the best plan? I would love for you all to just put it in the chat. We'll read some of the responses, but which is the best plan?
Okay.
And I'll throw it to you too. Which is the best plan?
Do I answer now before the rest of the chat answers?
Oh, I don't know. Start seeing what those responses are first.
I'll get it going and see what people say. So what I'm looking at is, well, at 25% down, I got a bigger IRR. But at 40% down, I'm making, I'm at 35% down, I'm net cash positive year one. And then at 40% down, I'm like super net cash flow positive year one. And, like even more in year 10 and all this type of stuff. So for me, because I'm not at a place where I want to, I guess I'm getting close to it, right? But like I'm at a place right now where I want my properties to basically like break even at year one. I would say that 30% down is probably best for me because 407 in a year is not that bad. I still get the higher IRR and I still get all those net profits. And I'm here for a long time, not just a good time. And I'm trying to maximize my IRR per property. Plus, I have cash flow coming in from the rest of my portfolio that also mitigates the cash flow outlay year one. That would be my answer for myself.
And I think that's a really good perspective. What I heard there is you want to make sure that number one, cash flow is taken care of. But you bring up a good point that your best plan here is to actually go cash flow negative on year one because you have
barely cash flow negative.
Barely cash flow negative makes sense because of two things. Number one, you have positive cash flow coming from your other investments that can balance out this $400 negative year one. So you've got cash flow taken care of beyond this property. And if you allow yourself to take care of cash flow beyond this property, what you recognize is that your return on investment, which is your ultimate goal here, is much better at 30% down than at 40% down.
Yeah.
Because you're taking a lot less upfront capital and it's working a lot harder for you. But it's great to hear some of the responses that I'm seeing there. I saw Denny put in there that it depends. I'm seeing Cecile says it depends where you are in life.
My boy Bob Wiesner saying best plan depends on one's personal circumstances. I want to bring up this one right here by Peter Kim. Peter Kim says 25% because you add another 35K and you can do two properties. Let's talk about that.
Interesting. So I love this. In let's call it average real estate investor circles, average investors are so fixated on only one profit center. They say the best deal is totally based on how much cash flow can it provide for me. But what we're hearing here in the not your average investor community, which we're here, I've had you say slightly cash flow negative is actually the best for you.
Mm-hmm.
And Peter Kim says 25% down may be best for him because if you put less down, you can add more properties and your money is even working harder for you at 25% down than at 30%. So if you're somebody that looks at this as 25% down, you're probably somebody who says a couple of things. Either you're willing to go cash flow negative without other sources of income to supplement it, which some people are a little bit more speculative that way. And you want the bigger pop down the line. Yep. You are focused on the best return on investment. 25% down might be the best plan for you. What I hear often is high net worth individuals who have a considerable income coming in that have excess savings each month. They start to look at it and they say, well, maybe 25% down is the right amount for me because I'm already taking more than $1,247 a year and I'm putting that in savings or I'm putting that in some other investment vehicle. And they say to themselves, well, if I put that additional $1,247 a year into this investment, it's going to produce a better return on investment than my alternatives. Yep. And so if you're a high net worth person, if you have a lot of excess income, 25% down might be the best approach for you. And we put plans together to do that. And why are we doing that? Because our job is to produce the best risk-adjusted return for you at your time of liquidation or whenever, or as long as you want to hold on to the properties. And that might be 10 years down the road. So technically, if you came to me and you're like, how can you make my money produce the most for me over 10 years? The answer is putting 25% down or even putting 20% down. Yeah. But that doesn't mean it's right for everybody. That's where that planning component and working with a team like ours that has seen this example and your example and thousands of examples can come together to build the right customized plan for you.
Yeah, I like it, man. When I think of that psychology, well, first of all, Michael Pedro Santoris over here says, if you're earning a good income with your W-2 paycheck and need the deductions and have the cash, put 25% down. If you have a lot of cash but looking for cash flow, put down 40%. Well summarized.
Absolutely.
Mike Foster says his son put down 20% so he could afford to buy a second JWB property.
I love that.
Which is great. I think of that. I think of that psychology of putting 25 or 20% down or even 30% down. It's not too unsimilar to how I think of my 401k, right? Like you can invest in all sorts of things in your 401k, but you're used to every single month, 5%, 10%, 15% of your income going into that thing. If you think about rental properties as, hey, that 1247 of cash flow negative in year one of 25% down, that's what, $100 a month?
$100 a month.
Right. So if you just think of automatically taking $100 a month out of your paycheck and going into that, now, you know, it's the same psychology as investing into like an automated kind of thing that people have set up. You just got to think about it a little bit differently. And if you're there for a long time and you know your income's going to go up over time, you know, your cash flow is going to go up over time just from the property, and you can afford to like put that mindset aside of like what, you know, my grandfather always said, save 10% of your paycheck, you know, and put it that way. It's pretty much the same thing. Yeah. Or very similar.
I mean, this concept of putting money into investments on a monthly basis or an annual basis is something that people do in many other places already, and they're cool with it. Your 401k example is a great example. Like I'm comfortable putting money into my 401k every paycheck. I won't say most Americans, but many Americans are comfortable there. But for some reason, in average circles, when it comes to rental property investing, people are like, listen, if it's not cash flow positive, it's not paying me cash flow every single month, I don't want to hear about it. It's a bad deal. But the numbers say otherwise. That's why this is the not your average investor community, because we look to all 5 profit centers and your total profits and your return on investment will actually be higher if you are willing and able to go cash flow negative. So that's not saying that that's right for everybody, but I think that might be the most controversial viewpoint that we might go through today, because everybody's sort of on board with, hey, if it's cash flow positive, I'm good. You know, but I do want to point out that we put plans together, just like Mike Foster's son we just talked about, right? That plan for you might be less than 40% down or less than 35% down.
Mhm.
And that might be the right thing for you. And, I know a lot of folks, I know the down payments required and purchase prices have gone up a lot in recent years. There's a significant opportunity to get in for less down payment if we can make sure we solve the cash flow solution. And then, if we're looking at all 5 profit centers.
Our boy Sergio Preto, Go Gators, says net cash flow positive break even for me every month. We're here for that good time.
I love it.
So, and we've talked about that a lot. There is a benefit to being net cash flow positive every month because, again, it's a little bit more scalable in the sense that, like, if you are getting to it every single month and it's net cash flow positive every month, you can keep stacking properties because it's not going to then mean all right, now I got to save 20% of my payroll. Now I got to send 30% of my payroll. But at the end of the day, you just got to wait a little longer and save a little bit more money in order to put it in, right?
Yeah, and we should go through, I would say for a first-time investor, the general feel is we're going to set up the plan based on cash flow positive right off the bat. I'm assuming they don't have other sources of passive income coming in. It's their first time investing with us. There's a whole lot of tangible value beyond just the dollars and cents to make sure this is paying for itself every single month. So that's sort of where we start. That's where I started. 18 years ago when my first rental properties, I was putting a plan together for myself to make sure it was at least cash flow positive. So I would say if you're a brand new investor, that's probably where we will go. Not every time, but that's more likely. As you get to be a more experienced investor, if you are a member of JWB Elite, which means that you own at least 5 properties or you own at least 10 properties with JWB, we're going to start to have conversations about what are you doing with that excess cash flow that comes in every single month? And if you've got $2,000 of excess cash flow coming in every single month, and you're just tucking that away and putting that into a savings account somewhere, and you don't need it, we might say, hey, why don't we go and buy the next property at 25% down and use that cash flow in a way to produce the best risk-adjusted return for you so that in 20 years, when you want to liquidate this thing, we built a bigger pile of money for you, right?
Yeah, that makes sense. And again, that is, if you want to have that conversation and get detailed on your situation and look at your financials with somebody that knows how to look at this stuff, go to chatwithjwb.com, schedule a call. You could do it. Vincent Barberite says, I currently own 3 properties with JWB since 2018. Do current clients go to chatwithjwb.com to schedule a call as well?
Vincent, first of all, thank you for your trust. It's been a pleasure serving you since 2018. For a current client like Vincent, just go and reach out to your JWB portfolio manager. You have their contact information. That's the best thing for a current client. And if you're a new client, generally you'll want to go to chat with JWB and set a call or send an email. Anybody can send an email. info@jwbcompanies.com. If you're not sure if you're a client yet or not, just go there and we'll make sure we get you set up.
Mike Foster saying, so is this roughly about 3.5% for closing costs?
Great question, Mike. So actually what I'm using is the current environment for closing costs, which includes a rate buy down for the client. And so it's actually higher than 3.5% for this exercise. Generally, it's about 3.5% for closing costs plus any rate buy downs. And so that's what we use here.
Man, we got a bunch of other scenarios to run through here in the chat. The community always coming through. All right.
Love it.
Paytruck, Ken Moline, First Family. You may have heard of them. So he says, start with the 25% down, but have a plan to build your portfolio at, say, 1 home per year. We started with a need for cash flow, so our first 2 homes were bought for cash. How did we get the cash to buy? Jumbo reverse mortgage.
Amazing, right? You're building a plan right off the bat that's right for you today. But the intention here is that your situation, especially financially, improves each and every year. And so your plan is not stagnant. It doesn't always stay the same. One of the things we get to do with clients is typically on an annual basis, we get to sit down and have what we call our performance review. And we get to sit down and review expected returns, actual returns. How are we performing? Why is it working so well? If we stubbed our toe a little bit, why did that happen? Bringing everybody into that conversation. And then the question is, how is your financial situation? How are we getting to that end goal for you to accomplish your why? And what steps do we need to take today? What steps do we need to take in the next 3 months or the next year? And that's where the next buying plan date comes to, at least we have an agreement on it and we start working towards that. Because if you have that end goal in mind where you want to go, and you're working with a team that knows how to get you there, and your financial situation continues to improve and stay on course or get better and better and better, you got to have a place to put the money. And if you're happy, then you're going to want to continue to add properties to your portfolio as well. So it's a part of our normal way of working with clients. And what Ken's talking about here is exactly what we were able to do with him. He started, first of all, Ken is an incredible, I was going to say pioneer, entrepreneur, courageous individual, but somebody who's not the norm.
Not an average investor.
Not an average investor, right? He came to us, figured out the reverse mortgage strategy for him personally, and came to us and said, "Hey, here's
a home in Northern California, right in Silicon Valley.
Yeah,
appreciated like crazy over very many years, and then came to you with what?"
His previous investments were not solving the problem for him. They weren't meeting the cash flow requirements for him. And he said, I got to do something different.
Yep.
And he came upon us through a referral, and he had already researched the jumbo reverse mortgage solution. So he had his source of capital, and we helped him, and we said, okay, let's go cash right off the bat for your 2 purchases, because cash flow was the most important need for him at that moment. As other needs started to come up, like, how do I grow this pie the most while also meeting my cash flow requirements? We started to buy properties with conventional financing. And there were many people that told Ken he was never going to be able to get a conventional loan because he's retired. And many people are assuming that you can't get a loan when you don't have active income coming in. But through our connections, we were able to help Ken get a loan. And now we have this incredible portfolio for Ken, which is meeting the cash flow requirements. So his quality of life is very, very high. But also is there to grow the bigger pie for him, for his future generations. Yep. And it's a beautiful thing. It's something that we love to do, is to build that customized plan and see it work through fruition.
2 things in that story that I think go unheard often is, number one, your network of connections is really impressive, right? Like the ecosystem that you guys have created around JWB makes things possible that most folks assume is a no.
Yeah, very
right?
true.
Like, for example, myself, I got quoted a 7.125% mortgage for my place that I just closed on. Greg made one call to one guy. I got on the call with him, and I got a 6.3% mortgage, right? Like, so, he's coming to the summit, so you'll get to meet him.
Absolutely.
But just this access to people that know how to move real estate and have been doing it for so long, and you guys have tested and vetted, I think is huge, right? So the idea that someone that's retired could get a mortgage, you talk to anybody, like, right, don't even look at that. That's a waste of time.
Right.
Going to chat with JWB, scheduling a call, running it through them, that to me is the resourceful, not your average kind of like resource that you can get out there, right? So like, if you have a unconventional situation where somebody's telling you no, I think hopping on a call with JWB's team, who does this all day long, is definitely worth your time before you just recluse yourself to like the average mentality. Second is this idea that, Ken was, we always talk about the fact that you always hear this idea of people late in life are just like, oh yeah, no, this is a great call that you're doing this, too late for me. But at the end of the day, I think folks that are late in life subscribe to this idea that, hey, based on the way that I have always been saving, and my retirement planner has always been telling me I had to save a certain way to get to a certain point. And once I'm here, I cannot take any extra risk. I can't do anything unconventional because it's going to hurt my cash flow. It's going to hurt my things that I'm doing. And by the way, if something bad happens in the market, I just got to take it in the teeth. But real estate provides this avenue that creates more cash flow as time goes on without increasing risk, even late in your life, and provides for a more stable kind of like cash flow when you need it scenario, if you're thinking about it the right way, even if you start at 80 years old.
100%. I mean, people in their heads think that they assess risk very differently.
Yeah.
But if you actually assess risk on what is historically, how often has the home value or the bond value or the stock value gone down, real estate wins there. If you look historically, rates of increase of cash flows, real estate wins there. So it's these things, the stability of it, if you just look at the figures on it, should make you feel have a sense of peace of mind in the real estate asset that you're investing in. But many people don't think of it that way. They think real estate, specifically single family rental properties, they think it's risky.
Yep.
And I wonder how they define risk.
Yep, that's a fair question to ask. A couple other fair questions. Vincent Barbright in the Q&A says, "Is your net rental income number in your net rental income number? Are you accounting for any maintenance or vacancy?"
Absolutely. The maintenance and vacancy numbers are accounted for there based on the historical performance of JWB's portfolio.
That's right. What he didn't say is they are accounted for based on some like rule of thumb that I got out of a pamphlet by a realtor.
Sure.
They are accounted for based on historical performance of homes just like yours in the Jacksonville market, using the same vendors used to like fix the house when it was originally fixed or renovated or built, and actual pricing of what you're seeing currently today. So
100%.
the best numbers you could possibly get. Mike Foster asks, how many lenders does JWB have in its network of trusted lenders?
It's a small number. I'm guessing that it's less than on one hand. Those are our primary lenders that we work with. We want to keep that number small because we want to be a significant source of business for those lenders, because that's to your advantage and to our advantage. You know, we want to make sure that when you go through this process of buying your rental properties, that you are way more than a number to that financial institution and to that lender. And so keeping our list of lenders very small as far as our primary lenders, we make sure that, you know, not just are the financials going to work out the way that it's presented, but the client experience is going to meet our standards as well.
Personal anecdote. Lender that Gregg introduced me to lives in Orlando, shut up for my closing today.
How about that? Huh?
So
Absolutely.
showed up for the closing today just to be there for support. Kind of needed it because I made a bonehead mistake in the whole process. That being said, I remember you telling me, right, I had another, the lender that had originally quoted me matched the rate and offered to like pay for my appraisal. And you're like, hey man, the most important thing here is that you're working with somebody that you really believe can get this deal done for you in the amount of time said. And I just took your advice and I went for that. And it worked out really nicely, man. So,
you know, and it's the easiest thing in the book for another mortgage lender to undercut somebody else and say, I can do the rate a little bit smaller. I can do this. First of all, usually what happens is that deduction that they give you shows up somewhere else down the line.
Yeah.
But at the end of the day, it's the network, it's the trust, it is all the little things that have to go right in order for this closing to happen. And you want to work with a team that has done this hundreds, if not thousands of times on that exact same asset with JWB, with our clientele. So I'm glad you made that choice. And I know,
me too, man.
I know others are happy about that too.
Yeah. Mike's follow-up question is, should we as buyers, as investors, ask each of those lenders for a rate quote when they're buying with JWB?
We do all that for you. So all of our lenders and the small group of lenders that we have, it's less than on one hand. I don't know what the exact number is, but we quote all of our lenders every week. They have a report and they share all of their information on what they are quoting this week, along with any types of, you know, there's a lot of variables when you go to quote a rate. So we have a standard approach to make sure we're comparing apples to apples. So we do all of that for you. And then we measure bandwidth for the lenders to make sure that they're not overloaded. And that's the lender that we're going to recommend for you. So done all the heavy lifting for you.
Smart. Okay. Speaking of smart, Vincent Barbright's got a great comment here in the chat. Says the less you put down, you are following an accumulation method of investing as opposed to an income method. All depends on your situation. I try to do both methods. And if talking about accumulation methods, Pamela Meyer says we are cash flow negative every month with our JWB property as we put only 25% down. We're good with that, knowing it will change in years ahead.
That's exactly right. And that's a very sound strategy for Pamela. What she's also looking forward to is her pile of money at the end of, 10 years, 20 years, however long that we're looking at here is going to be bigger than if she put more down.
Yep. Patron Santorio says, I was cash flow negative $300 a month on my first property with a 10.5% interest rate. Just going to let that one simmer.
Yeah.
After a few rental increases and refinancing down to 7%, I was at cash flow positive with a lot of equity.
So much to learn from that comment and relate it to today.
Yeah.
Right. Michael shared this story when he was a guest investor not too long ago, and I think it was so impactful. Number one, I remember he told me how he was all about taking action. And I think Michael, you let me know, but I know somebody in your family kind of was at least influential in helping you get started in real estate, maybe even forced you to buy your first rental property. And they said, just buy it and hold it. It is going to work out. And even though interest rates were higher at that point, they realized that they would come down in the future. And all that would do is take that potentially a cash flow negative situation and turn that right around to be cash flow positive very soon. And then it would just get more and more cash flow positive as the years happened. Now, Michael's portfolio is impressive. He shared that with us. And so thank you for sharing your story. It's very impressive today, but it wouldn't have started unless he took action and bought that first one and did it in a non-conventional way. Surrounded himself with people in his network who helped him see the light on how rental property investing can change his life over the course of 10, 15, 20, 30 years. And now he's a success story.
For Michael, it was his mom who forced him to buy it, knowing it would pay off in the future.
There we go. I remember that.
Good old moms. Yeah, that's right. That's right.
Definitely love moms.
We love moms around here, for sure. Doug Harold says, you work with non-recourse loans via self-directed IRAs. Doug, fancy you asked that because on Tuesday, we have Jason DeBono, who is the president of New View Capital, is one of the self-directed custodians that JWB works with to help people invest in self-directed IRAs, solo 401ks, all that good stuff. So we actually have a show on Tuesday about it. But the real answer is yes, 100%. JWB does that all day long. We'll help you do that. Go to chatwithjwb.com if you got questions about that. Super knowledgeable on it. Did I miss anything there, GC?
Just know that the numbers are going to change than what I shared here. This is all based on conventional financing, non-recourse loans. Absolutely, we do that. But the numbers will change, and we'll walk you through it as we build your plan.
Leslie Wilson, the Maven, says, I did a cash out refi on my primary residence and two of my most expensive Denver rental properties to get my JWB down payment money.
Gosh, I love these stories. Look at all these different. This is incredible. Thank you guys for sharing.
So that is a creative way to get the capital for the down payment of what you got going on. You can refinance your home. You can do HELOCs in your home.
Absolutely.
401k loans, which we're going to be talking about often.
It's something that I think we're going to be talking a lot about. I've said it from day one on the show that if the only thing holding you back is the money to get invested in real estate, that is generally the easiest problem to solve. And I know people think that I'm crazy for saying that, but it's only because I've seen that over 18 years. And if you can overcome the other things, if you can surround yourself with the right team, if you can get educated, if you can get comfortable with this, if you have the right investment plan, the money is the easiest part to solve. If you want to talk more in depth about that, it's a great opportunity to talk to my team, because these strategies that you're hearing in the chat right now are all real. They might work for you, or there might be a number of other strategies that we have seen work for clients as well. So don't feel like it is this in this mountain that will never be climbed. Yep. That being said, we're not miracle workers. It doesn't mean that today we're going to solve that problem for you. But generally, when you surround yourself with the right people over a short period of time, you can get there if you really want to.
Love it. Misty and Troy Johnson, past stars of the show, top
Absolutely.
10 attendees.
Top 10.
They say ours were all cash flow positive until the mortgage companies messed with the escrow in year 2, then came up short, and we have to make it up now. We are working on HELOCs on a couple of properties to have down payments for additional properties. How could that happen, GC?
Oh, that happens all the time.
Okay.
And I'm glad. First of all, thank you, Misty, for that comment and for sharing. This is one of those things that nobody tells you if you're a first-time rental property investor. But what happens is mortgage companies are notorious for screwing up escrows. So we put this perfect plan together. The loan is working perfectly. We know exactly what your property taxes are. We know what your property insurance costs are and things like that. And we have the loan in place. And at that point, the lender, who has access to the same information for property taxes and insurance, has their own way of going about what they escrow for you. That means the money that they hold back so that they can pay for your taxes and insurance for you on your behalf. It's a part of your mortgage payment. Well, we have no bearing on what they actually set aside because they're a lender and they many times screw it up. They can screw it up in one of two directions. They can screw it up in the direction where they take less from you, meaning your mortgage payment is lower than we told you to expect. Your escrow is less. And so on a cash flow basis, year 1, it might be way better than we told you to expect. But what happens is when they go to pay the property tax bill and the insurance bill at the end of the year, they don't have enough. And so they pay that, but the next thing they do is they start to increase your escrow next year. And so there's a little bit of a pendulum swing. This doesn't happen every time. I hope it doesn't. We hope that it doesn't happen, but it is still very common, and it's not something we can control. So we like to let clients know that this is a potential that it can happen. All that happens is in that scenario that I just shared, you had more positive cash flow than we told you to expect in the first year, but it was artificial. And the second year, you gave that back. You had less positive cash flow than we told you to expect. So you gave that back. And generally by years 3, 4, it gets in line and the mortgage companies figure it out.
Got it. Great explanation, man. Yeah. Brian McKay says taxes increase usually when the city recategorizes it as a non-homestead. Is that something that's normal?
That is a true statement, but it doesn't affect the cash flows for a JWB property, because when we estimate your taxes for you, we remove the homestead exemption, which would artificially lower your property taxes. So we know enough we remove that, even if it says that on the public record, so that when the evaluation comes, that you make your decision based on it, it has the property tax impact absent of any homestead exemption.
Got it. Mike Foster says, will any of JWB's lenders allow us to pay taxes and insurance on our own instead of escrowing funds in each month?
Maybe. It's a conversation. It's not too typical, but I have heard of it before, and I don't know if that's lender specific or not. But Mike, just reach out to the team. It's worth a question for sure.
Got it. All right, GC. Well, just kind of, you guys remember this picture. We haven't done one of these in a while for the OGs out there. Our POT dubs, our property of the week.
You know it. Week.
This is what they look like, right? This is what the investment looks like these days, right? Purchase prices. And this one says 11.65% IRRGC.
How about that, huh?
How is that different than the 9+% that you were?
It's just a macro look versus a micro look.
Okay.
Everything that I'm doing as far as portfolio planning is using averages and a macro sense of how I would build a portfolio for 1, 3, 5, 10 assets over a 10-year period of time. So I take the averages for our portfolio. This is a micro look. This is the individual asset that you have the opportunity to purchase, which happens to have an IRR that's higher.
Love that. Love that. So if you want to take an actual look at real estate, at JWB inventory, and first talk through your plan and what's good for you, and then get a look at properties and look in the micro, go to chatwithjwb.com, schedule a call. If you're an already existing client like myself and many others on this call, just reach out to your portfolio manager. I know I got an email from my portfolio manager yesterday just explaining some new interesting things and new teammates and stuff like that. So you'll generally have an email from them in your inbox at some point in the last 30 days. Reach out to them or go to chatwithjwb.com. Talk through these scenarios yourself. Great call, man.
Great, man. It's funny how sometimes we start the show and we're like, listen, this might be a short one.
Yeah,
we don't have 3 topics to talk about, and it never fails. We're an hour in and we had just a really fulfilling
I really enjoyed. We started going through the things, and then everybody started posting in their own things, right? Like, I think the real value, and I was actually just telling Cole about this yesterday, like the real value in this kind of community play is just seeing what other people are doing. In most companies that you deal with, you're just finding out from a salesperson what's good for you. You don't know if incentives are aligned, blah, 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 right? Well, like with JWB, you have the benefit of seeing us every day and trusting us every day. But even more than that, like just hearing everybody's individual scenario and being able to outsource context from each and every one of you to see if it makes sense for the next person. It's such like a help with the lift of getting people to understand this asset class, getting people to understand that there's different ways of doing it, getting people to understand that you don't have to be an average person. Like you don't have to do it like everybody else does, right? Because there's a bunch of other people doing it this other way and it works. So like really thank you. And we said that 90+ people would show up today. 90+ people showed up.
We hit it.
Yeah. So, this show would not be the same without this community. Thank you so much for showing up here on a Thursday, middle of your work week. You do it every single week on Tuesdays and Thursdays, and it just isn't the same without you. And we're super pumped to get Jason DeBono back on the show to talk about investing with your retirement funds, which I think is another one that brings all the boys to the yard.
It is. Yeah. It is another one that brings all the boys to the yard. I think that was the perfect intro to Jason and why we would love for you all to be there on Tuesday. You're going to get a ton of value out of it.
Yeah. So have a great weekend. Hope to see you Tuesday. But from now till then, any advice you see?
Don't be average.
See you next week.